Hello, George. Once again, macro issues are dominating the minds of investors. We have resumed conflict in the Middle East, its attendant impacts potentially on inflation and monetary policy. In the United States, we've got high equity valuations and indices dominated by AI-related names. My question for you is more on the bottom up. What are you and the team seeing in terms of bottom-up opportunities?
Well, Andrew, one of the more interesting phenomena we've seen in recent quarters is that despite low equity risk premiums and low volatility at the index level, dispersion among individual stocks is very high. In theory, that should be good for active managers, and we have, in fact, taken advantage of the opportunity to recycle some capital in areas that have performed well and redeploy it in a handful of new and existing investments. I would say there's no single overarching theme to these investments. We were able to allocate capital to a regional bank in the US. We saw opportunities in commercial services, in consumer discretionary businesses, and in the mining sector. And of course, as we've discussed in the past, the AI disruption narrative continues to pressure entire sectors and create what we believe are meaningful dislocations between price and value. And we've been active in targeted opportunities there as well. So, all in all, a highly idiosyncratic collection of bottoms-up investments.
You mentioned the mining sector. My question is on real assets in general. Why is that a potentially relevant area for investors in today's market environment? And what are you at the Global Value team doing in terms of your real asset investments?
One of my favorite topics, as you know. Look, real assets are interesting today because they sit at the intersection of several powerful historical forces. First, you have this dynamic we've been talking about of an accelerating rate of growth in fiscal debt in the world's reserve currency and the lack of political will to address it. The temptation to print money has proven hard to resist for democratic governments, regardless of which party is in power, and increasingly so since the pandemic. Scarce physical assets can serve as a potential hedge against this dynamic when they're relatively fixed in supply, like gold, energy, copper. Second, the pace of development in technology and AI today is breathtaking, and understandably, investors are eager to participate in that growth. However, not only does AI potentially threaten long-established business models, but the pace of innovation is so rapid that the investment landscape, especially in the technology sector itself, has become very unstable. This year's winners can suddenly become next year's losers. It's very hard to pick the long-term winners. Long-duration real assets offer a degree of protection against this kind of technological disruption and obsolescence. Finally, as we've been discussing with clients for several years now, the US economy, and by extension the US stock market, has transformed over the past several decades and become capital light. That's important because if you own stocks passively through the broad indices, you own almost no real asset exposure. Today, if you add up energy, materials, real estate, and utilities in the S&P 500, that's a kind of rough proxy for real assets. It's less than 10%. Just two tech stocks, NVIDIA and Apple, make up 15%. Across our diversified portfolios, we hold roughly 30% real assets, so roughly triple the equity market. It's a meaningful exposure and an important diversifier for our investors.
Thank you very much, George. Look forward to speaking to you next time.